Hello friends, what's up? Let us continue corporate finance. This is the third video of this particular lesson. And up till now, we have studied about the balance sheet of a company, right? We have understood what is there in the balance sheet. There are assets, there are liabilities, and there is also shareholders equity, right? Shareholders equity. And we know a simple formula that asset is equal to liabilities plus shareholder equity. This we have to keep in mind. Okay. Then after this, we also saw about the income statement of a company. It is also known as profit and loss statement, okay, or company's earnings statement. So basically it shows what is the total revenue of the company, what is the gross profit of the company, what is the net income of the company. Then we have also seen some terminologies like EBIT, EBITDA, right? So all these things we have seen. If you want to revise it, you can go back to the previous videos and you can see them. Now in this particular video, we are going to study about some financial ratios. Okay, so basically from these statements, that is balance sheets and income statement, we get some raw information about the company as to what is the asset position, then what are the current assets, what are the current liabilities, what are the long-term assets, what are the long-term liabilities, right? In income statement also we get different things. But in order to do a better analysis of a company's position, of a company's health, financial health, we do little bit analysis of that company by working out some ratios. Okay, so we find some ratios by using the data from these two statements basically. And in this video we are going to see what all different ratios we see for a company. Not just we, but these ratios are important for financial analysis of a company. So basically, if there is a bank which wants to give loan to a company, okay, so these banks will look at these different financial ratios as to because these ratios indicate the health of the company. For example, see, whenever we go for our medical test, right, in our medical test they will check your hemoglobin level, right? They might check your hemoglobin level, then they might check your WBC level, your RBC level. They do different kind of analysis in our medical test. So these different analysis, they tell us how is the health of the person. Similarly, in order to look at the health of the company, the banks and creditors and also investors, okay, and even the company's owners, okay, the owners or the the promoters of the company, they also periodically continuously look at the financial ratios of their company as to understand what is the health of their company, financial health of their company. So I hope you have got this background. Why do we study the financial ratios? Now, there are three important indicators of a company's financial health. Okay, so just like our health, okay, in our health, maybe one of the indicator is our body weight, then our height, our metabolism rate, our blood, our hemoglobin levels, etc. So there are different indicators of a body's health. Similarly, there are different important indicators of a company's financial health. So the first indicator is basically your liquidity. Okay, liquidity of a company. What is the meaning of liquidity? Liquidity means it is the ability to turn assets into cash quickly. So how quickly you can convert your assets into cash, that is the measure of liquidity. Meaning, for example, if you have a building, okay, if you have a building and if you have say some shares of say Tata. Okay, this is, I am talking about an individual. For example, an individual, he owns a building, okay, and he also owns some shares of Tata. So say for example, the cost of the market value of the building, the cost of the building is say 50 lakh rupees. Okay, the cost of the building is 50 lakh rupees, and he holds the Tata shares of say 25 lakh rupees. Okay, now you tell me whether it is easy, it is like which one is easier and quicker to convert into cash, whether selling the building or selling the shares is quicker. So definitely our answer is that it is the shares. So shares can be very quickly converted into cash. You can sell the shares immediately on the stock market exchange and you can get your cash. Okay, but selling a building, selling the land, selling fixed property, selling machineries, it's very difficult. So it depends. Okay, so we have to look at what are the different assets of the company and how quickly these assets can be converted into cash. Okay, so that is a measure of liquidity. Then the second thing that we have to look at is solvency of a company. Okay, what is the meaning of solvency? Solvency basically means ability to pay off debts. So basically whatever debt, whatever credit you have taken from the market, from the banks, from the creditors, from the NBFCs, whether you are able to pay those debts or not. Okay, whether you have enough assets, whether you have enough income or not to pay your debts. That is the meaning of your solvency. And the third thing that we have to look at, third indicator, is the profitability of the company, ability to generate income. Whether, see, a company is doing a business, right? A company has invested money into machineries, into factories or any other thing. So it is doing a business. Now in this business, it should be able to generate income. It should not be that, it is making losses and, it is not able to even, get back its, revenue, the cost also. So basically it should be able to generate income so that it will grow. Okay, whether the company will grow in future, whether it is able to generate income or not, generate income for its shareholders, for its promoters or not, that is also important to see. So basically we will look at these three things. Okay, the liquidity, solvency and profitability. These are the three indicators that we have to look at. Now let us study which metrics are used to measure these parameters. Now we have to see one by one as to how do we measure the profitability, how do we measure solvency, and how do we measure liquidity. Okay, so let us start. Now first of all, let us see profitability. Okay, how do we measure profitability? Profitability meaning what? What is your profit? Okay, what is your profit? The profit you are generating, the income you are generating for a company. So naturally the first indicator of profitability is your gross profit. In the income statement we have already seen what is gross profit. Okay, gross profit is basically your net sales revenue, your net sales revenue minus your cost of goods sold, right? So this is your gross profit. That is the first and very gross indicator of your profitability. On another level, if we further go, then we also look at the operational profit. We again know what is the meaning of operational profit, right? It is the EBIT basically. EBIT is your operational profit. Again, you obtain this from the income statement directly. Then the third indicator of profit is your net income, right? See, you are just narrowing down. So if this is the gross profit, then your operational profit will be this. Then if further you reduce something, then your net income becomes this. So you are basically narrowing down the indicator, okay, to just look at the different kind of health of the company. So net income, again, you are directly obtaining it from the income statement. Okay, so we don't need to really go deeper into this now because we already discussed this in income statement. You can go back and watch that video. Now basically the most important thing that we have to look at are these two things, 4 and 5 number, return on equity and return on assets. Okay, these are very important. Okay, very important indicators of a company's profitability. Okay, how much profit it is able to generate, and whether the company is in good financial health or not. So return on equity, see, return, I have explained it to you in the previous lessons also. Return basically means, okay, whatever you are getting out of given investment after you reduce all the cost of investment, okay, everything. So return basically means whatever financial return or income you are receiving. Now return on equity meaning what? See, it is a percentage of your total income, okay, meaning your net income, after subtracting all the cost, whatever return is left with you, okay, divided by the equity. Okay, so equity means what? Equity is basically the shareholders equity, okay, the common stock that is available in the market. So it has a very simple formula. It is a percentage of your net income, okay, with respect to the total equity of the company. So net income divided by total equity is your return on equity. Now net income you get from the income statement, total equity you get it from the balance sheet, right? Whatever is the total equity. So see, basically this total equity, we know the meaning of equity, right? It is a common stock. For example, if a company has issued stock, say at 2000 per share, okay, 2000 per share, and there are say for example 1 crore shares, okay, 1 crore shares. So there will be 2000 crore rupees of equity. Okay, so that is a total equity. Now there might be a question, if what if the company has issued share two times, once at 2000 rate and another time at 3000 rate. Okay, so for example in 2011 this company issued shares at 2000. After 5 years in 2016 it again issued shares at 3000, okay, per share, and it had issued say another 1 crore shares. So now this is 3000 crore. Okay, so you add this 2000 crore with 3000 crore, this will become your total equity. So basically you have to look at the total equity of the company that it has issued, that is there in the market, and you will look at the book value of the shares. Okay, equity means the book value of the share. Book value means what? The price at which the company issued the shares to the market originally, that is the book value. See, this shares was issued in 2011 at 2000, but maybe in 2023 the value of this share is maybe say 5000 rupees. So you will not consider this 5000, you will consider this 2000 only, the book value of the share. Okay, that is very important. So whatever was the original book value of the shares, that you have to consider here. So return on equity is basically net income divided by total equity. So okay, so this is formula. And return on assets is basically your again net income divided by total assets. So it looks at the net income from the perspective of the assets that you have. Okay, see, one simple formula I have told you, assets is equal to liability plus equity. This we know. So in equity we are only considering this part, equity part, okay, return on equity, we are only considering this part. But in assets we are considering assets plus liability, equity plus liability both. So in denominator here, in denominator assets is basically your liability plus equity, whereas here it is only equity. Okay, so let us understand what it tells. So ROE, return on equity, tells us how well a company is managing the capital that shareholders have invested in. Equity is what? Equity is basically the money of the shareholders, right? It is the money of the owners of the company that have put. So if ROE is high, okay, if ROE is high, it means that a company is generating more income per unit of the equity, right? Per unit value of the equity, the company is generating more income. So it is generating more income for the owners of the company, for the shareholders of the company. If ROE is high, company is more efficient in generating income and growth from the equity financing. Okay, if ROE is high, it means because of the equity, company is generating more income and it is more efficient in generating growth from the equity financing. Now on the other hand, what is ROA? ROA is return on assets, indicates whether a company is using its assets efficiently or not to generate profits. Okay, see, a company is using its asset for manufacturing process, for business, right? Buildings, land, capital, etc. So ROA will tell you whether a company is using its asset efficiently or not to generate profit. Okay, if ROA is high, it means that if ROA is high, what it means? It means that a company is basically generating more profit per unit of its asset. Okay, per unit of its asset, company is generating more profit, meaning it is using its assets very efficiently. Now ROA factors in the company's debt while ROE does not. This I have already told you, because see, ROA, in the denominator there are assets. Okay, it is a net income divided by assets. So assets is what? Asset is your liability plus equity. So liability is basically your debt. Okay, all the debts you have taken, that is your liability. So ROA has this debt in the denominator, whereas ROE does not have it. Okay, so ROE does not talk anything about the how it is generating income out of the debt it has taken, the loan it has taken, but ROA will tell you that information. That's why these are the two different indicators. Now ROE and ROA are usually compared for the firms in same industry, since they have similar asset base. Now see, different industry, meaning different sectors, they have different asset base. For example, if a company is manufacturing, say if a company is manufacturing cars, okay, You just try to understand that a company's one sector is manufacturing of cars, and another sector is okay, manufacturing of pencils. Okay, now definitely in cars, the asset base will be larger. Okay, they will have very intensive investment, capital investment, because of the heavy machinery and different kind of things. Whereas in pencils you don't need lot of machineries. Okay, maybe it is very labor intensive rather than capital intensive. So you have to, so if you compare a company in a manufacturing car sector with a company in a pencil sector, it will not be a fair comparison. It will not be a good comparison. For example, if you compare Maruti Suzuki, okay, you compare Maruti Suzuki with Natraj company. Okay, Natraj is a company of pencil. So it won't be a fair comparison, because these are in two different sectors and they have different asset base. So usually ROE and ROA, we compare it for the firms in the same industry. So you will compare Maruti Suzuki with Honda, you will compare Maruti Suzuki with Hyundai, etc. Okay, Toyota. Similarly, so you have to compare firms in the same industry. That is a good way to look at it. Otherwise your analysis will be distorted. Now let us look at the next index, which is the profitability, which is the liquidity. Okay, we have to look at the liquidity now. Now liquidity, we already know, it measures how quickly a company can pay off its debt by liquidating the assets or using cash. Okay, by selling its assets, getting the cash and paying off the debts. That is the measure, that is the liquidity. Okay, now what are the different ratios which are used to see the liquidity? First one is the current ratio, quick ratio and cash ratio. Again, I'll explain it to you what is the meaning of this. See, current ratio is basically the ratio of current assets divided by current liabilities. We know what are current assets, we know what are current liabilities. Current assets are the assets which a company can liquidate within 1 year. Current liabilities are the liabilities which the company owes within 1 year. Okay, it has to pay those liabilities within 1 year. So current ratio is basically your current assets divided by current liabilities. So see, if your current assets is 5,000 and if your current liability is 2,000, okay, so basically your current ratio is 2.5. So what does this mean? It means that you have 2.5 times the current assets than your current liabilities. Okay, so you can pay 2.5 times the current liabilities from your current assets. That is the meaning. Now quick ratio is again further a narrow narrow indicator of the same thing, same liquidity thing. Basically, see, in current assets we know that there are different kind of assets. Current assets: cash, cash equivalents, inventories, marketable securities, etc. Now it is said that some of the researchers and financial researchers, they said that inventories are not very liquid. Okay, and inventories, to sell off your, see, if you have some inventory in your godowns, it is not very easy to sell them. Okay, once your company is going bankrupt or you're liquidating, it is not very easy to sell your inventories or dispose of your inventory. So basically they say that we should subtract the inventories from the current assets, and whatever is left after that we should consider to look at the company's financial health. So all your current assets, including cash, cash equivalent, marketable securities, etc., you subtract inventories from that. You don't consider inventories, and then you divide by current liabilities. So for example, if your current asset say is 5,000, out of this 5,000, inventories was 1,000, so remaining is 4,000. Okay, so 4,000 is basically your current assets minus inventories, 5,000 minus 1,000, divided by again your 2,000. So your quick ratio becomes 2. So what does it say? That your quick ratio is 2, meaning what? Your current assets minus inventories is 2 times your current liabilities. That is what it says. Okay, now let us look at the next thing. The next thing is cash ratio. Okay, what is cash ratio? The name itself suggests cash ratio, meaning in the numerator here we will only consider cash and cash equivalent, very, very liquid. So these are very, very liquid assets. Okay, extremely liquid. Cash is 100% liquid. Cash equivalents is basically, example is marketable security. For example, you have some shares or you have some bonds. You can immediately sell in the market, and within 5 minutes, 10 minutes, half an hour, you can get the cash. So that is cash equivalent. So here in the numerator, again, you narrow it down from the current assets. You have already subtracted inventories. Now you subtract all other type of current assets also, and you keep only the cash and cash equivalent, and then you divide by current liabilities. So for example, if your cash and cash equivalent, out of this 4,000, other you subtract and say for example it is 1,000. Okay, cash and cash equivalent with the company is 1000. Your current liabilities remain 2000, so it is 0.5. See, now this ratio is a narrower ratio. Okay, so it says that you have cash and cash equivalent only half of your current liabilities. Okay, only half of your current liabilities can be paid off from your cash and cash equivalent. So these are the different ratios of liquidity. We are looking at, current ratio, quick ratio, cash ratio. Just try to understand that, we are trying to look at, how well a company is able to pay off its debt with the with the liquid asset after liquidating the assets. Okay, so current ratio measures a company's ability to pay short term obligations due within 1 year, because current liabilities with your current assets. Higher the current ratio, it means better ability to pay off debt within time. Lower current ratio meaning sign of distress or high risk of default. See, if your current ratio is low, that means maybe within 1 year you will not be able to pay your current liabilities. Okay, so it is a kind of distress, it is a kind of stress of the company, financial stress, that the company is not able to pay its obligations which are due within 1 year. For example, within 1 year, within next 1 year, you have to pay 800 crore rupees, but your current assets are only 700 crore rupees. So 100 crore rupees you are going to default. So that is what it indicates. Then current ratios should be compared with the industry average. Okay, again, see, you have to look at the particular industry. For example, cars, you have to look at a particular sector, cars, pencils, okay, mobile phones. So you have to compare the current ratios of a company within a given sector. Okay, industry average you have to compare. So for different industries, there are different current ratios available, because some sectors they have more current assets, some sectors they have more current liabilities. It depends on the business. Then quick ratio. Quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets. Okay, it is most liquid, meaning, see, liquidity is increasing as we go from current ratio to quick ratio to cash ratio. Okay, so here we are looking at the most liquid ratio. So current assets except for inventory. Inventory is not considered to be the most liquid. That's why we subtract inventory from the current assets. It measures a company's ability to pay its current liabilities without needing to sell its inventory. Okay, see, this is the interpretation of current of the quick ratio. Now, cash ratio. Okay, what is the cash ratio? Already explained to you. Ability to pay off current liabilities with cash or near cash resources. Okay, cash equivalent. Example, marketable securities. It is the most conservative measure of the liquidity. Okay, very narrow measure of liquidity, as it considers only the most liquid resources of the company. The most liquid, that is cash and cash equivalents, these two. So I hope you have understood about liquidity and profitability in this particular video. We have already talked about these two things. Okay, profitability and liquidity. And if you have any doubt, please ask me in the comment section. We'll continue this particular lesson in one more video. And after that, we are going to start a new lesson. Thank you.